Welcome to this explainer. Today we're completely stepping away from the noise, the hype, and all those get-rich-quick fantasies that tend to cloud the trading space. Instead, we're taking a cinematic, analytical look at the actual architecture of risk. We're going to break down Week 22 of the GoldMining Guardian live trading system. Ultimately, this is a story about cold, hard math. It's about systematic execution and setting up a purely defensive posture across the currency markets.
Right out of the gate, we're looking at a pretty formidable number here, a 78.35% all-time growth rate. But I actually need to stop you right there so we can establish some ground rules for this explainer. What we are looking at is a live RoboForex cent account. So we are tracking cents, not full dollars. Now, you might be wondering, why do it this way? Well, because when you strip away the heavy emotional weight of massive dollar signs, you're left purely with percentage metrics and statistical reality. We're essentially looking at the machine's pulse, totally uncorrupted by human panic.
So let's zoom out for a second and see how this builds over the long term. This system didn't just magically stumble into success. It methodically climbed from an original baseline deposit of 2,500 cents. And today, that balance sits confidently at over 4,367 cents. The trajectory is undeniably clear, and the long-term target on the horizon is 10,000 cents. It's a marathon, for sure, not a sprint, and the steady upward curve is the ultimate proof of concept. Section 1, Week 22, Steady Execution. Okay, so to truly appreciate that massive, sweeping curve we just looked at, we kind of have to put it under the microscope. We need to look at the day-to-day grind. For this specific week, the system generated exactly 0.81% in account growth. Now, to the untrained eye, making less than 1% might sound completely boring, but to a systematic trader, boring is beautiful. This is a highly controlled, incredibly modest growth rate that strictly prioritizes survival over adrenaline. In absolute terms, that growth translates to a weekly profit of exactly $34.88. Again, just grounding ourselves in the reality of that cent denomination. The system executed its strategy, collected its 34 cents, and protected the baseline without getting greedy. And honestly, this brilliantly illustrates exactly how defensively it played the week. Just look at those risk metrics. The maximum drawdown for the entire week was a literally microscopic 0.925%. And the deposit load? It peaked at barely 0.306%. The system basically didn't even break a sweat to secure that 0.81% gain. It was practically ghosting the market. Section 2, the USDC equity test. But listen, trading is never without friction, right? You don't survive in the markets without taking a few punches. And midweek, our smooth sailing was definitely interrupted. If you inspect the purple line running right beneath the blue balance line, you'll see our equity line. Notice that distinct, sharp drop right in the middle of the week? That is equity pressure happening in real time. The market pushed back. And as an analyst, this is the exact moment I want to see. How does the machine actually respond when the water gets rough? Well, watch the automated defenses fire up. Here, the red line maps the drawdown, and the blue line tracks deposit load. You can see the precise moment the strategy reacted to the dip. The drawdown spiked temporarily as trades went underwater, but check out the blue line. The deposit load was kept exceptionally low, well under a single percent. The system just absorbed the shock completely without over-leveraging the account. What's really fascinating here is the specific market action that caused this stress. Driven by recent shifts in broader US dollar sentiment and fluctuating treasury yields, the USCAD pair took a sharp structural dive. Over in the transaction log, you can see the system took a direct hit, a temporary closed loss of 38.71 cents. But it didn't panic. It immediately recalibrated, firing a larger precision strike that booked a 44.68 cent recovery win. The algorithm simply took the hit, process the data, and punch right back to neutralize the threat. Section 3, Diversification as Defense. Now, while the Canadian dollar was creating all that localized turbulence, the rest of the portfolio was quietly just doing its job. The contrast here is actually amazing. Normally, as you can see by the all-time historical weighting, EURUSD handles about 49.71% of the workload, but looking just at week 22, EURUSD dominance exploded to 75% of the total trading activity. When the USDCAD pair became hostile, the euro stepped right up to do the heavy lifting and stabilize the entire account. Let's dive into the specific M15 timeline for the euro.
fueled by shifting central bank expectations this week, specifically changing Fed rate sentiment weighed against steady ECB posturing. Just look at the sheer volume of those blue and red arrows. These are rapid-fire, absolute precision entries and exits. While the Canadian dollar was rigorously testing the system's defenses, the euro was essentially acting like an economic engine, churning out dozens of micro-profits that totally offset the broader portfolio pressure.
And the result is completely undeniable. Follow the blue line. That represents the euro's aggressive stair-step climb in cumulative profit throughout the whole week. Then compare that to the flatter, much more volatile red line of the Canadian dollar. This is exactly what non-correlated performance looks like visually. One asset struggles, another soars, and the overall balance just keeps pushing forward.
Section 4, Masterclass in Risk Management.
So if we zoom back out to the macro view, week 22 perfectly encapsulates the overarching philosophy behind this entire operation. It's really not about being right on every single trade. It's about engineering a portfolio that bends without breaking. The absolutely crucial takeaway here is simple. Disciplined risk management is the ultimate edge. Surviving a market dip with a microscopic deposit load is infinitely more valuable to your long-term success than the sheer magnitude of any single lucky win. And to prove that this defensive stance isn't just a one-week anomaly, take a look at the lifetime statistics. Across thousands of trades and months of continuous operation, the absolute maximum historical drawdown has never breached 18.49%. This boring, highly defensive posture, it is entirely by design. The prime directive of the algorithm is, and always will be, capital preservation.
Section 5, the systematic long game. When you truly understand that preservation is the core goal, all the short-term noise of a single week just fades away, and you can clearly see the broader horizon. Look at these two side by side. On the one hand, you have the minor turbulence of week 22 we just dissected, but on the other, that's the all-time chart. When you place this week's little stress test against the 78.35% historical growth curve, that scary equity dip becomes a tiny, virtually invisible blip on the radar. The system just processed the variance and kept on climbing. Which brings us right back to our smooth, upward-trending equity curve. The math simply does not lie. Consistent, low-risk execution yields sustainable compounding over time. Step by step, cent by cent, the Guardian is ruthlessly tracking toward that 10,000-cent milestone. So, this leaves us with a pretty fundamental question to ask ourselves about how we approach the markets. Are you trading for a quick flip, constantly chasing adrenaline and risking total ruin? Or are you building an architecture for sustainable, systematic growth? Thank you so much for joining me for this explainer. I really hope this deep dive into the mechanics of risk helps you build a much more resilient strategy of your own.